SPY, the S&P 500 ETF, is down 5.15% this year, and QQQ, the Nasdaq 100 ETF, is down 7.75%. If we take a quick look at the technical analysis, we can see that SPY is down 9.35% from its prior all-time high, so it's very close to being in a correction level being a 10% drop, of course, while QQQ is down 12.8% from its previous all-time high, so the Nasdaq is already in a correction level. But both these ETFs are still sitting pretty comfortably above their 52-week low. We can see that in both cases, the ETFs are still closer to their 52-week high than they are to their 52-week low. Let's look at 5 dividend growth stocks that have declined more from their all-time high than both SPY and QQQ. Monolithic Power Systems is down over 40% from their prior all-time high. Microsoft is down 18.77%. Old Dominion Freight is down 28.39%. Ross Stores is down 21.36%. And Rowe Price is down 23.45%. And we can also see that these 5 stocks are trading at levels pretty close to their 52-week low. And Rowe Price Group actually set a new 52-week low earlier today. But just because these stocks have declined more than the market on average does not imply that they're great companies and that they are undervalued today. So let's take a closer look at each of these businesses, dig into their track record, see how attractively valued they are, and measure what type of long-term return investors can expect. I'm going to jump over to my stock review workbook, and we can pull up Monolithic Power Systems first. Let's give the spreadsheet a minute to gather all the data. Monolithic Power Systems overall is a pretty good company with an overall quality score of 84%. It has a very strong track record of revenue growth, with the 3, 5, and 10-year CAGR being close to or above 20%. And from the revenue growth chart, we can see this growth really ramped up from 2020 to 2022. Then the company had a flat year from 2022 to 2023, followed by another leg up in 2024. The 2025 figure is the trailing 12-month figure, and since the year just started, this metric isn't overly meaningful at this time. We can see that the free cash flow has grown faster than revenue, with the 3 and 5-year CAGR both being over 30% and the 10-year CAGR being 22%. Driving this spectacular growth is a leg up in the free cash flow per share between 2022 and 2023. In the dividend department, Monolithic Power Systems has delivered some outstanding dividend increases, with a 10-year CAGR of nearly 32%, a 5-year CAGR close to 26%, and a 3-year CAGR above 27%. Here we can see Monolithic Power Systems' short but very spectacular dividend growth track record. Moving down from the compounded growth metrics to the average metrics, let's start with gross profit margin. The company has maintained a very steady and robust gross profit margin of about 56%. We can see the gross profit margin expanded from about 2012 through 2022. Then it took a minor dip in 2023, but it seems to be leveling off here. The company has a very great track record for its return on invested capital, with the 10-year average being 18%, the 5-year average being 25%, the 3-year average being 31%, and the trailing 12-month figure being over 50%. You can better see that growth trajectory in this chart here. Monolithic Power Systems is a highly liquid company, with both short and long-term liquidity ratios well above 1,000%. The liquidity ratio chart isn't very practical, as these numbers are just astronomical. The dividend payout ratio for Monolithic Power Systems has been declining over the last 10 years. The 10-year average sits at 49%, the 5-year average is 37%, the 3-year average is sub 30%, and the trailing 12-month payout ratio is just 13%. We can see that better visualized in this chart here. The only negative aspect for Monolithic Power Systems here is that the company has increased its number of shares outstanding. The weighted average shares outstanding have grown by about 2% per year. From the chart here, you can see that there was one instance where the share count declined from 2018 to 2019. But for the most part, the weighted average shares outstanding have increased since 2012. Monolithic Power Systems currently trades for $570, and its fair price based on a free cash flow model is about $781, implying that the stock may be 27% undervalued at the moment. And if we look at the long-term return expectations, the 5-year CAGR for Monolithic Power Systems stands at a cool 24%. This is largely attributed to projected earnings per share growth of above 18%, a potential return to fair value of nearly 5% per year based on our valuation model, and the forward dividend yield of 0.88%. So Monolithic Power Systems has a great track record of fundamental growth, barring the one exception in its share dilution. It appears to be potentially undervalued based on its current free cash flow levels, and it has a pretty lucrative forward return expectation. The next dividend growth stock on our list is Microsoft, so let's pull them up. And again, let's give the workbook a minute to pull all the data. Microsoft's overall quality score stands at 97.6%, which is pretty phenomenal. The company has a very strong and consistent history of revenue growth. Free cash flow growth is a little bit scattered, but when measured over longer intervals, looks pretty solid. Its dividend growth history has been pretty steady, holding above 10% over the last 3, 5, and 10 years. We can see by the red trend line that dividend growth rates were more generous back in 2014 and 2016. But since 2020, Microsoft has held steady at about a 10% dividend growth rate. The company has a very healthy gross profit margin that has marginally expanded over the last decade. It has also seen a general improvement in its return on invested capital, moving from a 10-year average at 17.54% to a 5-year average close to 23% and a 3-year average above 24%. Looking at the chart, we can see a couple dips in 2015 and 2018, but more recently, the return on invested capital has pushed above 20% and stayed there. Microsoft has generally improved its liquidity, with a 10-year average very close to 100%, a 5-year average of 133%, a 3-year average of 155%, and the trailing 12-month liquidity at over 200%. From the chart, we can see that liquidity was very high in 2012. It then dipped, bottoming out somewhere in 2017, and has progressively improved since then. Microsoft's historical payout ratio has generally trended lower, with a 10-year average of 43%, a 5-year average of 27%, a 3-year average of 25%, and the trailing 12-month payout ratio at 24%. From the chart here, we can see two spikes, one in 2015 and one in 2018, that are highly correlated with the dips we saw in the return on invested capital. And in terms of share dilution, Microsoft has been buying back its shares at a rate of about 0.5% to 1% during the last decade. We can see the weighted average share count marginally declining from year to year. The stock currently trades for a price of $380, and based on my free cash flow model, its fair price should be around $339, implying that despite its recent pullback, Microsoft is still about 12% overvalued. However, despite this potential overvaluation, Microsoft still has a 5-year return estimate of 12.89%, largely stemming from its projected earnings per share growth of 14.33%, a minor negative component from the return to fair value, and a forward dividend yield of 0.87%. So overall, Microsoft has exceptional fundamentals. It has a pretty appealing 5-year return estimate, but it is potentially overvalued now, and I would prefer to wait until the stock dips further. The third stock on our list was Old Dominion Freight. Let's pull them up. Old Dominion Freight has an overall quality score of 94.6%, which is pretty phenomenal as well. Its revenue growth is pretty strong looking at the 5 and 10-year CAGRs, but it has declined over the last 3 years, with the 3-year CAGR being just 5.92%. And in the chart here, we can see stagnating revenue since about 2022. That is definitely cause for concern. Free cash flow has grown much faster than revenue, with the 10-year CAGR being 46%, the 5-year CAGR being 14.5%, and the 3-year CAGR being nearly 13%. Again in the chart here, we can see some stagnation since about 2022. So it'll be very interesting to see what kind of revenue and free cash flow Old Dominion Freight can deliver in 2025. The company has a very short track record of dividend payments, but it's been growing its dividend at a very spectacular rate, with the 5-year CAGR being 35% and the 3-year CAGR being 37%. Old Dominion has a pretty good gross profit margin, above 30%, and they've actually seen that gross profit margin expand from 2012 all the way to 2022. More recently, it's stagnated and dipped a little bit, but it's still holding at a pretty respectable level. The company has seen its return on invested capital improve during the last decade, with the 10-year average being just shy of 20%, the 5-year average being nearly 24%, the 3-year average being above 26%, and the latest trailing 12-month figure being nearly 25%. From the chart, we can see that the return on invested capital has jumped up and down, but generally moved in the positive direction. The company has a very healthy liquidity ratio, well above 1,000%, with the trailing 12-month liquidity ratio being much higher than the last decade, implying that the company is sitting on a lot of cash relative to their debt. Old Dominion has seen its payout ratio increase during the last few years, but it's still sitting at a very comfortable level, well below 20%. The company has also been buying back its shares at a rate of about 2% per year. We can see the weighted average shares outstanding declining pretty consistently since about 2012. The stock currently trades for about $167, and based on my free cash flow model, its fair price is about $158, implying that it's potentially 5.6% overvalued at the moment. Despite this potential overvaluation, Old Dominion Freight still has a 5-year return estimate of 10.8%, which is pretty good in my book. Much of this estimate is driven by projected earnings per share growth of about 11%, a minor negative component from the return to fair value of minus 1.1%, and a forward dividend yield of 0.67%. So overall, pretty healthy fundamentals, although the stagnation in revenue and free cash flow is a bit concerning and should be monitored going forward. The company is a pretty decent return estimate, but may be marginally overvalued at the moment. The fourth stock on our list was Ross Stores. Let's pull them up. Ross Stores has an overall quality score of 85.6%, which is pretty good. It has a pretty good streak of revenue growth, but the pace has been slowing down. Its free cash flow growth history is a little bit mixed, with a pretty healthy 10 and 3-year CAGR, but a rather sour 5-year CAGR. This can be explained by a decline in free cash flow post-pandemic in 2021 and 2022. In terms of dividend growth, the company has a pretty good track record, with a 10-year CAGR close to 14%, a 5-year CAGR of 7.5%, and a slightly better 3-year CAGR of 8.84%. Of course, we have to note that the company broke its dividend streak in 2020 during the pandemic, cutting its dividend pretty heavily. But in 2021, it resumed increasing its dividends and picked up right where it left off in 2019. The gross profit margin is pretty good and has been expanding during the last decade. We can see a very large spike in 2024, driving the short-term averages up higher. The long-term return on invested capital is pretty solid at 21%, but the short-term track record isn't that great. We can see that the return dipped in 2020, falling very close to 0%. It has since recovered, but remains below 20%. Ideally, we would want this metric to return to pre-pandemic levels, above 30%. The company has pretty weak liquidity relative to the prior stocks we looked at, but some of this is due to the nature of their business. We can see that the liquidity ratio was very high pre-pandemic. It then declined in 2019 and has remained low ever since. Ideally, I would want to see liquidity improve in the future, but as long as it remains positive, that should be good enough. Ross Stores has a pretty healthy payout ratio. We can see that it spiked in 2020 during the pandemic, and that's causing the 5-year average to be higher than the 10-year average and the 3-year average. Looking at the more recent payout ratio, the 3-year average is at a very nice and low 25%, and the trailing 12-month payout ratio is below 23%. Ross Stores has been buying back its shares at a healthy rate of about 2% per year. We can see the weighted average shares outstanding declining pretty much every year, even during the pandemic. The stock currently trades for about $128, and based on my free cash flow model, its fair price is about $132, implying that it's potentially about 3% undervalued. Looking at the 5-year return estimate, we have a return estimate of 8.47%. That is a little bit lower than I would like. My typical green threshold is a return of 10%. The components of this return are a projected earnings per share growth rate of 6.72%, a potential return to fair value of 0.61%, and a forward dividend yield of 1.14%. So overall, pretty healthy fundamentals, a potential undervaluation, but a return estimate slightly lower than I would like. The last stock on our list is Rowe Price Group. Let's pull them up. Rowe Price Group has an overall quality score of 80.4%, so it just barely meets the cutoff for a good company in my quality score. Looking at the actual data, we can see that revenue has grown during the last 5 and 10 years, but has declined during the last 3 years. The same can be said for free cash flow per share, but with much slower 5 and 10-year CAGRs, and a pretty poor 3-year CAGR of minus 26%. The dividend growth rate has also been cooling down, with the 5 and 10-year CAGRs being above 10%, and the 3-year CAGR being only 4.71%. The company does have a pretty strong gross profit margin, above 50%, but we can see that it's been marginally declining since about 2021. We can see that same declining trend in the return on invested capital, with the 10-year average being 19%, the 5-year average being 17%, and the 3-year average being just sub 14%. In terms of liquidity, Rowe Price Group looks pretty strong, with both the short and long-term ratios being well above 100%. Rowe's payout ratio has remained pretty steady during the last decade, declining marginally if we look at the 10-year average of 46%, the 5-year average of 44.93%, and the 3-year average of 44.6%. And in terms of share dilution, the company has been buying its shares pretty consistently, but the rate of the buybacks has been declining, with the 10-year average being 1.5%. the 5-year average being just about 1%, and the 3-year average being just about 0.5%. So while the direction of the weighted average shares outstanding is pretty nice, the trend is slowing down. T. Rowe Price Group currently trades for about $96, and based on my free cash flow model, its fair price is closer to $110, implying a potential 13% undervaluation. The 5-year return estimate stands at 10.12%. This return estimate is made up of a forward dividend yield of 5.15%, a potential return to fair value of 2.5%, and a projected earnings per share growth rate of about 2.5%. If you enjoyed this analysis and you want to see more content from me, you can check out my newsletter, Quality at a Fair Price. I share a lot of my stock reviews and my research there. I would also appreciate if you gave this video a like and subscribe to the channel. Thank you for watching and see you next time.